This is ChangeMakers with Katie Gore, finding the right solutions for the affordable housing community.
This week's ChangeMaker is Daniel Nissenbaum, the Chief Executive Officer of the Low Income Investment Fund, one of the largest investors in low-income neighborhoods throughout the United States. Before becoming CEO of LIIF 3 years ago, Dan was a managing director at Goldman Sachs, where he oversaw Community Reinvestment Act compliance for the firm's urban investment group. Dan, welcome to the podcast.
Hey, Katie, great to be with you today. Thank you.
Let's just jump right in and start with what exactly the Low Income Investment Fund does, because I know you've deployed about $2.7 billion over the last several years.
Right, sure. And I know from listening to your other podcast that I'm not the first person from a CDFI. That's okay, I forgive you. So your audience probably does know what a CDFI is, but frankly, I think we're the world's best kept secret, although I think we're now coming to the fore. And by that, I mean CDFIs. Look, we all try to explain our jobs to our moms, right? And that's always a little complicated when you have a complicated organization. I describe LIIF simply as a nonprofit impact fund. And as you probably know, we raise capital and we on-lend it to community projects that the private market does not serve. So we really live in that inefficient part of the market where private capital does not flow, unfortunately, whether that's because of the scale of the projects we're working on or the complexity of the transactions we're working on, which is quite high, or the perceived risk, and I emphasize perceived risk, of the work that we do. So we're a bank. We're basically a bank. We receive equity in the form of grants from the federal government, and then we go to banks motivated typically by the Community Reinvestment Act, but we also go to philanthropy and government, and we're able to borrow 4 times the amount of equity that we have roughly, and then we make loans and we keep revolving it, and frankly, that the power of that leverage is pretty significant. For every dollar we get, we typically leverage it 12 times just from simply revolving our capital, and oh, by the way, not losing any capital as we go. And our industry, frankly, as does LIIF, has a sterling track record. We've been around now for about 50 years. I think collectively we manage north of $200 billion for investors, and we've had very low losses as an industry. And frankly, coming out of COVID, or still really being in COVID, but hopefully coming out of the worst of it, our industry, like we've done in the last great recession, was a first responder, and we're often the first ones in local communities, and frankly, we're the last ones there. We were able to deploy PPP loans, and we were able to help local governments deploy CARES Act money. So I can keep going and talk a little bit about the complexity of the work, but that's, I hope, just an overall explanation for those who may not be as familiar with CDFIs.
So what are some of the towns and cities that have been impacted by some of LIIF's work?
So LIIF is a national CDFI. There are lots of different types of CDFIs, and you'll often find a CDFI that's focused in one state or focused in one region. LIIF really grew up, over the last 37 years. We started in California, and actually we started as the Low Income Housing Fund. we really were focused on housing initially, although I'll talk a little bit more about how we expanded our work and really became known for community facilities. We really were focused on the integration of community development activities. We've grown and we've expanded our platform. We have offices in 5 cities right now. That's San Francisco, Los Angeles, New York, DC, and we, in the last couple of years, expanded into the Southeast, where we thought there was a dearth of capital, and it really needed some mission-based lenders. And having said that, we've lent in over 25, 26 states, typically through partnerships with other CDFIs or through our new markets tax credit activities. I will add, by the way, that within the last year, LIIF as a CDFI entered a joint venture partnership, which we're hugely excited about. It's with the Stewards of Affordable Housing, which is a coalition of the strongest and most prominent nonprofit housing developers in the country, and its ownership of a LIHTC, a low-income housing tax credit syndicator. So we now own that syndicator in partnership with SAFE, and so via that partnership, we've actually expanded our coverage even more through the Midwest and into other parts of the South. I do want to raise an issue around this because I think this is really important and it's something we're all struggling with in our industry. So CDFIs are really in every state. However, most of our capital we have been able to raise through banks that are motivated, as I said, by the Community Reinvestment Act credit. That's great. We've raised, tons and tons of capital. We've had great support from many, many banks, and it's been a wonderful partnership over the years. However, the CRA is sort of ancient as well, since 1977. And as you're probably familiar, because of the core concept of redlining, banks get credit for the investment that they make, which benefits their quote unquote assessment area. And that's typically where their bank branches are. And frankly, you and I both read the same newspapers. We know that banks are consolidating and bank branches are closing. That has much to do with the restructuring of the financial services industry overall. But that really curtails and constrains the work that LIIF and other CDFIs do. We're limited in meeting what is clearly a growing need and frankly a growing opportunity, to make investments in other areas. Frankly, that's where we're needed. If banks are covering a certain area, we should be both supporting their work but extending their reach. And
Right.
this is simply why do we still have a region called Appalachia with all the difficulties that they have? Why are rural areas falling behind? It's really much to do with this issue. And as you probably know, the CRA has been up for review, and the OCC under the last administration took this in a very difficult and what would have been a damaging direction. Unfortunately, that's been corrected. But they really, frankly, in the reviews overall, have failed really to expand the reach of CRA and allow banks to get credit for activities outside their assessment area. And this is something, that's going to be a continual issue. The CRA is still under review by the Fed. And one last thing I'll say is that the other major federal initiative, which was opportunity zones, right, which was targeted in much the same areas, but lacking any requirement for impact, has been let me see if I can find the most diplomatic term I can think of, which I would call a giant miss for local communities. So we do a great deal. We do it in a lot of places, but as you know, and as I've heard you talk to other leaders, that the need is simply increasing, and we have to think of ways to keep extending our work.
Well, and it seems that whether they're called opportunity zones or enterprise zones or whatever the new label is, the need does not change. So that makes me wonder, how exactly do you guys go about when there is so much need? How do you go about making decisions on where the investment is? Talk to us about what that decision-making process looks like for your team.
Yeah, great question. So I'll say a couple of things. Again, we have investors, and they have given us capital with a geographic restriction. So we're sort of first and foremost focused on meeting our investors' needs, and so that gets to a broader discussion about who we're serving. Because again, local communities have great needs in many places. So the first need is, geographic, and how do we achieve what our investors are asking us to do, because we need to report back to them, and much of the capital that we receive is restricted capital, meaning it is capital designated for a geography, and it often might be restricted to a certain activity. What I wanted to mention early on was the miracle of the Mackenzie Scott grant funding that we received, which was completely unrestricted and targeted to support our programs which were addressing racial inequity. And I hope we can come back and talk a little bit more about that. But I would say, simplest terms, we receive capital. We obviously have a product set. We've obviously built up a client base over a long period of time. We're active in the 5 offices, most notably, in which we've mentioned. And then, at the end of the day, we're a real estate lender, right? So much as with the other leaders you talk to, we look for transactions that meet a range of metrics. And one of those is, does the deal make sense from a mission perspective? Does the deal pencil out from a safety and soundness and a risk perspective? And, not every deal is profitable. We're in the mission business, and we think about this from a portfolio perspective. But can we make these loans and continue to be sustainable? So this is a wonderful moment for me to mention that we're actually in the middle of what I really foresee as a sea change in the way that LIIF allocates capital. And so by that I mean we launched a new strategic plan. So I joined 3 years ago. The board was very gracious, and our strategic plan was up for renewal, and they allowed us to defer that for about a year. And we spent a lot of time and frankly gave staff a huge role in the determination of our new strategic plan. And summarizing significantly, we really centered our plan on racial equity. We've all been lending, on affordable housing and charter schools and daycare centers and economic development projects. And frankly, we've all been watching, not just in the last year of the racial reckoning, but over years, that we have not been creating enough of the change that we've all wanted to see in these communities. And disparities and disadvantages persist and are frankly increasing, right? And so we, coming out of our strategic plan, have crafted a new framework. And it is something that we're calling the Impact, Risk, and Profitability Framework. And it is a model. It expresses our theory of change. It expresses our intent in how we're going to try to address racial inequity. We have an impact model, and we also fold in what the profitability of each loan is, and then we fold in the risk rating. And that isn't to say that every loan that we make will be the lowest risk and the highest profitability. It's actually quite the opposite. It is to say, we have a mission. We're going to get there by making us a number of different types of loans. And by the way, we also do programs and allocate new markets tax credits, and we're going to be trying to use this lens as well. And we want to understand our intent and understand our impact and really double down and focus on that, right? You can't be everything to everybody. We can't be addressing all kinds of impact. Frankly, we're only 100 people. We're tiny, but mighty, and we really need to focus our impact because a lot of other people are doing great work in the world. So by using this new framework, we really will be holding ourselves to a higher bar of accountability, that the loans that we're making will address racial equity, and starting to measure that. I mean, to be candid, right? I mean, I've been in community development finance for 2,800 years, it seems like. And look, we've all felt that we have been delivering capital, and we are financing rental housing. We're doing a lot of great work. But we also know that our industry is incredibly siloed. Mm-hmm. We know that capital flows to the path of least resistance. And frankly, we know that if it isn't, that bias isn't baked in different ways. And we know that it is, right? From the review of appraisals and the thinking about zoning and all that sort of stuff. Capital just flows to the path of least resistance. So while we've been doing great work, right, we have to think carefully about what the systems are doing and how they're allocating capital. And so it's not enough anymore to say, hey, it's amazing, we financed a 100-unit building and it's benefiting, low-income people or people of color or whomever, if you haven't been intentional about racial equity from the beginning, because that building may not be located near high-quality education. That building may not be located or have access to transit. And so part of that is to think more broadly about the transaction. Part of that is to think about who we are as an organization and whether or not, how much we reflect the communities we're trying to serve. And frankly, part of that is whom we're financing to do this work, which may well have a wonderful outcome of building this 100-unit building. But if we're only, for instance, financing white developers, the affordable housing industry is
Right.
really not known for its diversity in leadership, then that's not really creating real impact or real change or creating asset building or wealth building opportunities or just control of their own destiny, for developers and including nonprofits of color to do this work. So I've blabbered on a little bit. I apologize for that, but it's deep and we're changing the way we think about this, and our whole industry is coming around to this, and we have to do better because we're not really seeing the change we need to see in these communities.
Well, what's so interesting is that you've blended the organizational aspects and the operational aspects of what you're doing, by taking the strategy and even really your mission statement, and then also looking at the systems and structures of where you're operationalizing, in the different communities. And so I think it does take a touch point on all of those aspects within your organization, and then how you're delivering outside, externally. And you guys are really tackling a lot there. Even your mission statement, it says everybody in the United States should benefit from living in a community of opportunity, equity, and well-being. I mean, just even starting at your mission statement is one thing, but then cross over into where you're making investments and how you're trying to achieve these goals. It's such a fascinating approach for an organization. Let's talk more about the McKinsey Scott contribution and how in practicality that's going to play out. What's that going to look like?
Sure. Boy, that was really something. And I'm just, every time I think about it, I'm a little overwhelmed. We were, so you know, and your listeners probably know that Mackenzie Scott did one or two, I think she did 2 rounds of distribution. We were one of 7 CDFIs in the first round, which is about 100 groups. And we were so honored. And we were then in the second round so pleased to see many other CDFIs receive awards, great recognition for our industry and our work. I have to tell you, that was one of those. I remember where I was when I got that call because, frankly, we did have an inkling, and we did get a call from kind of a gatekeeper group, and they asked us a bunch of questions. That was one call for not a lot of time, and the second call was somebody calling to say, we're sending you this gigantic check. And in fact, I had to literally make them repeat it twice. I was stunned, just completely stunned. It's a transformational gift. There are others who received more, but it's got a lot of zeros in it, and we're doing great things with it. So it was great validation of LIIF's work and our ambition, and that was the best part of this whole thing. The fact that this money came as a fully unrestricted gift was beyond description. That is so hard to come by, as you probably know. You're in the business as well. And frankly, I think this gets to something that's a disease I call reverse engineering, where nonprofits are trying to accomplish a mission and do have to raise money in lots of different ways, and so therefore have to identify a range of funders, all of whom have different interests and geographic interests and impact interests. And you end up kind of running around trying to chase a bunch of money and then trying to cobble all that money together and then keep track of the things you're supposed to keep track of. And you kind of end up reverse engineering yourself, as opposed to going into a community and saying, this is the biggest and deepest need, and here's our solution for this, and then trying to go raise capital against that. So we all need to get away from that kind of what I call reverse engineering. It's really, it adds risk and complexity to all of our organizations. At any rate, so we used the money. We took this very seriously. It was fully unrestricted, but frankly, we kept asking, what are the requirements? What do we need to report on? And the answer was basically, you were identified because you were a strong organization and your mission is aligned with Mackenzie Scott's interests, so you can do pretty much whatever you want with it. Stunning. We certainly went to our board and had a long conversation about this and got some great advice. And we are limiting, we're certainly not using it for operating expenses, and we're seeing it as quite likely, although I hope this isn't the case, a once in a lifetime investment in LIIF. And so we're using it to make the investments that we charted out in our strategic plan. And that's around affordable housing, and that's around early care and education, and that's around what we're calling impact-led lending, meaning with racial equity, excuse me, as the focal point. So we have this funds. We're using it to build LIIF up as well with a little bit of infrastructure spending. We've taken a chunk of it and carved it out and actually given it to the staff to decide how to spend. Again, hopefully in line with those strategic imperatives. For instance, we rolled out a new loan product designed again in accordance with our strategic plan, and it was a working capital loan specifically for Black developers in the main do not have access to this type of capital. Pre-development, acquisition, working capital costs, that all of the difficult things that, as you need to spend money on in relationship to affordable housing project years in advance. And so we've used some of the money to fund the R&D of that product and to provide a little bit of credit enhancement for that product as we would with similar type products. And frankly, with that, the other powerful point is that we've been able to leverage that capital. When we developed this product, Arnold Ventures came to the table and provided several $1 million to help support this product. By the way, we then went on, given our new partnership with the National Affordable Housing Trust, our LIHTC syndicator, and we've created a fund, an equity fund, a LIHTC fund, similarly for Black developers. And we now have one major global bank which has stepped up and wants the whole fund to invest in. So it was a gift, a manna from heaven. It was transformative and frankly electrifying for our organization. And we've started work right away to use that capital for things that we can't get funding from other people for, right out of the door to get this work going. And it was wonderful recognition.
And well-deserved. Okay, Dan, hang on for just a moment. We have to take a break, but coming up in the second part of my conversation with Daniel Nissenbaum, the Chief Executive Officer of the Low Income Investment Fund, Dan talks about how LIIF's mission goes beyond brick and mortar buildings.
We've decided to focus, not to the exclusion of anything else, but to focus on affordable housing and on early care and education. LIIF has been a leader in the field of early care and education, and by that we mean centers for childcare and we mean home-based providers of childcare. Because in these two areas, given that we centered racial equity, we saw those two areas as areas of deepest inequity and growing inequity.
Thanks for listening to ChangeMakers with Katie Gore. To find out more about Katie, go to quadel.com. That's QUADEL.com. This has been a production of Forbes Books Radio.